Good afternoon, folks. I think we're going to give it a couple minutes here. We're 1 minute till our starting time, so I have a feeling we're going to have some folks joining, at that time and a few minutes after. So we'll go ahead and get things kicked off shortly. If anybody that's in the meeting can just give me a thumbs up or just say in the chat if you can actually hear what I'm saying, that would be great. Just so I know I'm not on mute or anything like that. Thank you for that. Wonderful. All right, so we'll give it about maybe 90 seconds or so, and then we'll go ahead and get things kicked off. All right, well, my clock shows we are 1 minute past the hour, so I'm going to go ahead and get things kicked off. Just a couple quick housekeeping items. My name is Glenn Usher. I'm the sales vice president here at Lincoln for our long-term care solutions, Lincoln's MoneyGuard product. I want to thank everybody for jumping in here, and especially want to thank the folks over at Algren. They're excellent agency partners, and can think of very few agency partners that are as knowledgeable across the board as far as the range of solutions and their application depending on the marketplace. So my thought is that you'll probably have a lot of follow-up questions. I'm certainly able to answer those. So if you do have questions, use it in the chat dialog box like you folks have been doing all day long. I have no doubt that if there's any questions that pop up after that, Charles or Brandon or Doug or Sam or anybody else at Algren will be able to answer those for you. You can certainly get my contact information as well. So the title of today's presentation is relatively vague, right? The evolution of the LTC landscape. There's a million different angles that I could take on this. So I'm going to give you a brief history just as far as my role at Lincoln and how that's evolved over the years, because it does play into the topic that we're talking about, plus what wholesaler doesn't like to talk about themselves. So I joined Lincoln 10 years ago as a member of their competitive intelligence unit. At that point in time, in 2011, was the first year that we crossed the $1 billion threshold in premium for Lincoln's MoneyGuard product. Back then, there were very few carriers offering hybrid policies. Some of the ones that I can remember were Genworth used to have a policy. John Hancock had a product called Life Care. Sun Life had a product. So while none of those products are in the marketplace, that was really when linked benefit sales really started to take off. So I'm going to take the approach, from my background in seeing that marketplace evolve as far as sales shifting from, let's say, traditional standalone long-term care insurance to products like hybrid, MoneyGuard products and other similar products. But I also heard in that last session, there are no shortage of life insurance products out there that have chronic illness riders, critical illness riders, long-term care riders. So I do want to talk at some length as far as how those products have evolved. So, fast forward the last 10 years, the LTC marketplace looks entirely different than it did 10 years ago when I joined Lincoln. So, the way that I'm going to sort of approach this presentation, and I will have some visuals just to give you guys a break from looking at me, but I want to keep this as product agnostic as I possibly can. Now, knowing that Lincoln and MoneyGuard kind of sign my paychecks, I will be touching on some of the nuances to the MoneyGuard, the process, the underwriting, and things like that. But I think over the next 12 to 24 months, you're going to see some very significant evolutions and innovations in the space in response to the external macroeconomic environment, with things like where the markets are headed, where interest rates are headed, which Brandon alluded to in his introduction. So I want to first start, I'm going to take the approach here of talking about, the evolution of LTC of LTC in really, three separate areas. So the evolution of underwriting and how these products are being underwritten, the evolution of the process, virtually how are you interfacing with the agencies and with the carriers. That's changed very drastically over the last 18 or so months. And then I'm going to end with how the products have evolved. And I think that's really where the meat of what most folks are here to learn about is what products are out there. There's so many to choose from. How do I know which product that I should be choosing? And then I am going to give a little bit of a teaser as far as where I think this marketplace is headed in response to the extremely low interest rate environment. So with underwriting and process, both of those are kind of inextricably linked when we talk about hybrid LTC insurance. The underwriting is just as much a part of the process as far as how you're actually submitting that business. That's not necessarily going to be the case with maybe standalone long-term care policies or with life insurance policies with riders. So where this marketplace has evolved from is a fully underwritten plan. So similar to what you're currently seeing on traditional LTC underwriting or life insurance underwriting, where there's APS statements, there's medical exams, there's all of that typically make that up. With MoneyGuard and with most of the hybrid products that are out there, we follow what's called a streamlined underwriting process. And this is a change that we made at Lincoln right before our sales started to explode. So if you think it's all about product, obviously when we made that change, within 2 or 3 years, our sales exploded from about $300 million in premium threefold to over $1 billion in premium. So that tells us that the process and the underwriting is absolutely as important. And the convenience to the client is obviously something that they're going to want to be focused on. So with our streamlined process, when we made that change, with these products, all of the underwriting is done completely over the phone. And I'm going to talk on what some of those changes are over the last few months here. But when we made that change, we shifted to a completely streamlined process, meaning all of the underwriting is being done over the phone. It's typically done with a 45 or so minute phone call with a vendor that we use, as well as the client. There's no APS records. There's no paramed exam. And that typically moved us from a 2 to 3 month process, from a fully underwritten process, to a full process from end to end that could really be completed in about a month's time. So that had a big role in sort of the dynamics of shifting between the fully underwritten plans. Now, keep in mind, there are still a lot of fully underwritten policies out there, like their standalone traditional LTCI, a lot of life insurance, while they are moving to sort of automated underwriting and that sort of thing, depending on the level of coverage. Most of those are going to have a fully underwritten plan as well. But that's really been Lincoln's underwriting process for the last, probably call it 15 or so years, until the last 24 months, where we've made some significant changes there. So what I want to talk about today is, first touch on COVID and the impact that that's had on underwriting, but then ultimately dive into the process as far as how business gets done with these types of policies. So, COVID has changed the life insurance industry. It's changed every other industry, some industries for the better, some industries for the worse, and some industries we probably won't find out how it's changed them for a few years. I can only speak specifically to the LTC marketplace, and I can talk and tell you what Lincoln's guidelines are temporarily as it relates to COVID, because I know that's probably the number one question out there. And I can tell you that most of the LTC carriers are going to fall in line with what Lincoln is currently doing. So when you look from an underwriting standpoint, how that's evolved over the last 12 or so months, most carriers have either significantly limited or completely eliminated applications for folks over the age of 70. With Lincoln, we were in that marketplace for a little while with some restrictions, and then Lincoln was frankly one of the only carriers that was still offering coverage. And then later last year, we are temporarily suspended all applications for clients over the age of 70. So that's still going to be the case. I think over the next 6 to 12 months, that'll likely change, and I think we will start to see things opening up as you get more vaccinations and the spread of COVID cases goes down. So that is a temporary change. Typically, when we're talking about who we're speaking to about hybrid products, with Lincoln, we're talking to folks from 30 to age 70. So a pretty wide demographic. And when I talk on product, I'll give you some of the details as far as, why somebody in their 40s, how they might approach this type of product versus somebody that might be in their 70s. So it'd be impossible to touch on underwriting without at least, giving a little bit of a nod to COVID and how that's changed things. But I think where COVID's had its biggest impact, not just at MoneyGuard, not just at Lincoln, and not just at, as an industry as a whole, is carriers having to adapt. And I can speak from working at an insurance carrier for the last 10 years. Nobody would ever confuse an insurance carrier as being technologically advanced. Right? Since I was at Lincoln, it was, hey, we're moving to all these technological advancements. We're doing virtual capabilities, right? And that was all kind of things that we were saying, kind of moving at a snail pace. Things are moving extremely slowly until about March of last year, when that forced every insurance company to say, we need to continue doing business. We need to continue to deliver value to customers. If we're still working on a paper to paper process where we are taking paper applications, we're taking that application, and then we have to basically mail that to the insurance carrier. The insurance carrier gets it, hopefully, right? They then take the case, they scrub the app, they code that case. That whole process was taking somewhere around 7 to 10 days for most carriers. So you're talking about a process that ultimately was getting lagging behind by about a week, and that's even if the case was in good order. So some of the changes that we made at Lincoln MoneyGuard are going to be the same changes that every other carrier are making, and you're probably connecting those dots to say e-app, e-delivery, e-capabilities, virtual capabilities, all of that. So I'm going to try to share my screen here in just 1 second. So let me know if you folks actually do see it when I pop it up here. Just give me 1 second. This is the first time I'm using this this particular platform. So all right, you should be seeing some of our e-capabilities that we have here at MoneyGuard. And again, I'm not going to spend too much time on this. I don't want to make this a product specific, but some of the capabilities that we have at MoneyGuard, we are the first in some of these as far as a hybrid product. Most carriers have adopted something along the lines of e-capabilities and that sort of thing. I would be remiss if I didn't mention New York isn't always the fastest to approve things. So we do have a lot of things pending as far as our e-capabilities and that sort of thing. At Lincoln MoneyGuard, we do have a product available in New York, but the e-capabilities aren't quite there yet. So, if you're dealing with folks that are in Connecticut, New Jersey, or anywhere else in the country, we have these approved in most other states. So some of the changes that we've made since COVID, starting with e-app, the ability to submit business electronically. We've always had a leg up with hybrid and streamlined underwriting processes with these types of products, frankly, because we're not going out and getting medical records, we're not putting the client through exams. Particularly in at the outset of COVID, a lot of folks not necessarily wanting to go out to a doctor's office, meet and do exams. So we did have a sort of leg up as far as the process that we were already using and had been using for 15 years. So the question was, well, in response to this, if folks aren't necessarily able to meet with their financial advisor, or maybe they just don't want to because of COVID concerns, how are we still able to continue delivering value to that potential client? So we rolled out e-app last year, and that's available, again, in all states except for New York, and I believe California may not necessarily be on that list yet. We offered the opportunity, instead of waiting for the phone call, to schedule their PHI phone call, which is, again, the only underwriting that we do here at MoneyGuard. The ability to schedule that online at the client's convenience. We rolled that out last year. We also rolled out a program called eNIGO. So if there was a case that, we just needed an additional signature or something was missed and something needed to be changed, the old process was, well, we need a completely new paper, or we needed to send out the old and have the client initial it and then fax that back in or snail mail it. Obviously, that was causing a lot of significant delays. So, those pending case tools like eNIGO allow us to kind of make some of those changes on the fly. And then looking at e-delivery. So MoneyGuard is now a completely end-to-end process. We can take an application, we can do the underwriting, we can schedule that call, and we can deliver that policy all electronically. And that's a huge change that's happened over the last year. And you're seeing that across the board from virtually every other carrier and every other life insurance product out there. So the thing that we did announce toward the end of last year, so if you haven't looked at MoneyGuard in a while, virtually all of the underwriting that we were doing here at MoneyGuard was being done over the phone. So what we've rolled out at the tail end of last year, effective November 16th, was the ability to complete e-interview. So all of those questions that we're typically asking a client over the phone, which are, their medical history, the drugs that they're taking, and things like that, clients now have the ability to log onto a portal and answer all of those questions. And if they say, yes, I'm a type 2 diabetic, it'll kick out some additional questions for them. So the advantage there is, you have clients that maybe are a little bit concerned about jumping on the phone and they're a little bit nervous. There is a cognitive component to it. So what this does is allow clients to jump into that portal at their own convenience. They answer all of those health questions ahead of time. If they are over the age of 60, we always do have to do that cognitive screening. But the phone call for that client is now going to be about 10 minutes versus 45 minutes. And if they're under the age of 60, where we don't do that cognitive screen, for most of these clients, they'll never have to jump on the phone and they'll never have to interact with anybody. So that's a huge change and a huge convenience for those clients. Oh, by the way, that's reduced our turnaround time as far as getting that interview scheduled and completing by about 2 weeks. So that was probably the longest delay that we had at MoneyGuard. Is we would get an app in, especially if we get it in with eApp, we were turning it around pretty quickly. But you're trying to get a client on the phone. When you finally do, they're scheduling out their interview a week or 2 weeks in advance to make it convenient for them or outside of their work hours. So what this does is say, whether it's 12 noon or midnight, the client can jump on, answer all of those health questions and get it done. And if they're under the age of 60 with no cognitive screening component to it, they'll never have to interact with anybody, whether it's at the vendor or at Lincoln. So a huge win. It's significantly shortened the underwriting process. The feedback thus far, again, now we rolled this out toward the end of last year, but all indications so far are that folks love it. The convenience of it. It's very user friendly when you jump into it. So some really exciting things happening there. So over the last year, the process as far as how we do business, how we receive business, and how we underwrite that business has undergone a pretty significant change there. We can follow up with any of the pieces that we cover on this. But the entire marketplace has evolved. This isn't just a Lincoln thing. So you are seeing other hybrid carriers out there doing similar things. I believe Lincoln is the only carrier that is doing this e-interview where you can actually complete the full interview without jumping on the phone and speaking with anyone. So that's a huge win for Lincoln. That's a huge win for the client. And it's a huge win as far as the turnaround time on the process of these particular plans. So I want to shift gears here because I spent most of this talking about, frankly, things that aren't all that exciting. They're exciting to me because I work in this space and I finally have things to talk about. But I think most folks want to hear about, well, what products are available. So I mentioned earlier when I joined Lincoln, it was Lincoln and a couple other hybrid carriers. There are several other hybrid carriers and from very reputable companies. So a lot of good selections out there. Every life insurance carrier now has some form of LTC riders or chronic illness riders or all of those. And we've really seen those explode, I would say, probably over the last decade. So when you look at the macroeconomic environment, the only solution that most folks were gravitating toward for probably since the 1960s was what they call standalone LTC insurance. So standalone LTC insurance, if you're not familiar with it, it's virtually the pay-as-you-go, use it or lose it proposition like a lot of other insurance policies, right? So you get quoted, a pool of benefits is going to cost you X amount of dollars a year in premium. That's usually the biggest bang for your buck when you're talking about, how much leverage do I get to potentially pay for these long-term costs. So, LTC insurance was really kind of invented back in the 1960s, and it was really invented as sort of a supplement to Medicare and Medicaid. And the first iterations of these policies were very restrictive. They were really, a lot of them were called nursing home policies because that was, something that wasn't covered by Medicare, potentially covered by Medicaid. And that's actually something that we've been trying to shake off in this industry for a long period of time because when you look at the stats as far as who's receiving care in the country, less than 10% of folks are actually receiving care. So when we talk about how the products have evolved, so too has the actual care and how that care is delivered. And the products have evolved sort of to go along with that. So you see, most LTC products in the market today are going to cover not just the nursing home, they'll cover the assisted living facility, the home care agency, receiving care in home. A lot of times unskilled care being covered in home. So there's a lot of variety to choose from as far as how clients want that care to be delivered. So I do want to kind of flash back. When you look at the profitability of LTC products, particularly hybrid products, and again, Brandon alluded to this in his section in the beginning, talking about how hybrid products really follow along with the fixed UL sales in the last year. Fixed UL, guaranteed UL, all of those from an insurance company standpoint are very dependent on the interest rate environment. So I'm going to share my screen once again. This is something that most folks have probably seen before. Let me get this shared. Just give me 1 second. All right. This chart should look familiar. So what we're seeing at the bottom is starting in the year 2000. This is the 10-year treasury rate, right? So when you're an insurance company, especially in the GUL space or in the fixed insurance space, a lot of the product and a lot of the profitability is dictated by where the interest rate market goes. So you see, the financial crisis, 2008, 2009, interest rates tanking back in 2010 or 2011. I remember Operation Twist, which kind of flipped things on their head as far as interest rates, and you see that 10-year treasury going down. The more that you get compressed and the further down you go, so 100 basis point change from 550 bips to 450 bips, not all that impactful from an insurance company. But when you talk about that same 100 basis point change from going from 200 bips to maybe 100 bips, a lot of change in the profitability of these particular products. So in 2011 is when we hit the $1 billion mark in premium with Lincoln's MoneyGuard product. So you can see that right around here. And then you see interest rates tanking. So what did that do? That made Lincoln, forced to say, hey, we're taking on, a lot of these policies are single premium funded, heavily funded policies. They're guaranteed policies. So, how do we kind of spread our risk so we're not taking on, $1 billion of single premium business? So these products evolved, probably in that 2014 timeframe when we moved from MoneyGuard Reserve Plus to MoneyGuard 2. We also saw a shift from single pay business to flex pay business. So, clients that weren't just funding it with the CD that was maturing, now you're seeing folks in their 40s and 50s saying, hey, if I can get into a guaranteed LTC solution and I can tack inflation riders on it, and I'm guaranteed that my premiums are never going to go up. Oh, and by the way, I get a death benefit if I never need the long-term care. You saw folks that are much more insurable, right, in their 40s and 50s, locking that insurability in and getting into this product. And instead of funding it with maybe $50,000 or $100,000 single deposit, you're spreading out that investment over 5, 10, 15 plus years with these types of policies. So that was really the first kind of big change and evolution in this space in response to what was going on in the interest rate environment. Another big change was MoneyGuard's story was always leverage, legacy, and liquidity. So when you look at the leverage with long-term care, as interest rates go down, you're typically seeing the leverage impacted. Every carrier in the LTC hybrid space was impacted by that last year. You also saw some changes in that liquidity aspect. The what if I don't want this coverage anymore? It used to be a day one return of premium. That story has kind of changed. Most carriers are on a sort of vesting schedule as far as if you want to get all of your premiums back. So that was the second evolution. And that was back in about the 2014 timeframe. And then you saw interest rates kind of ticking back up right there, right? So in 2018, 2019, pretty healthy 3% 10-year treasury. And obviously over the last year, we've seen interest rates absolutely tank. And you've seen that reflected in the leverage that these types of policies are providing. And you've seen carriers pull back in some of these areas. So I show you that not necessarily to tell you something that you don't already know, right? Most folks kind of understand as the 10-year treasury goes, the profitability for a lot of these products go, and eventually that's going to get passed on in the form of decreased death benefit, decreased LTC leverage, depending on the type of product that you're talking about. So I want to talk about a little bit Lincoln's product portfolio going back to, again, when I started 10 years ago. Lincoln used to be the GUL carrier. We had 70% of our business coming in on guaranteed universal life, which was great when you were talking about a 5% 10-year treasury. It was a profitable product to us. We provided a lot of value to a policyholder. But what happened was, interest rates tanked, and Lincoln found out very quickly that, hey, it's probably not best to have all of your eggs in the GUL basket. So we implemented a protect and pivot strategy at that particular point in time. So we protected those GUL sales. It's still a space that we're currently in, and a space that we see a lot of value in delivering to customers. But we had a huge pivot at that point to products like VUL1 with Lincoln, which is a guaranteed death benefit product with upside potential. We saw the shift to indexed universal life and a shift to term insurance. And now Lincoln, used to be the number one GUL carrier and didn't necessarily have a broad product diversification. Now we are a top 10 player in virtually all of those product lines that I talked about. So the strategy at that point in time was, let's protect these sales, but let's also pivot to products that might be a little bit more profitable for the insurance company. It might be a little bit more risk sharing with the consumer, but for a consumer that wants that upside and is willing to take some of that additional risk, an IUL product might make sense, or a VUL product like VUL1 or Asset Edge with Lincoln might make a lot of sense. So I say all that because you may have already heard it's probably the worst kept secret in long-term care at this point. I'm getting questions on it already. So where do I see this marketplace evolving over the next, probably 2 months if you're talking about Lincoln, but certainly over the next 12 to 24 months? Insurance carriers are going to look at their hybrid policies and they're going to say, do we still have the same value prop to these clients that are maybe in their 40s or 50s when we're looking at a 10-year treasury that's hovering around 100 basis points? And the question becomes, well, is there a way that we can share a little bit in that risk and pass some of it on to a policyholder if they're willing to take that risk? And that's where we're going to be introducing, multiple products probably over the next 18 to 24 months here at Lincoln. When you take a look at it, you're probably connecting the dots to say, well, Lincoln shifted from GUL to a VUL product. Is that going to happen with MoneyGuard? And I see some of the questions in the chat box are asking directly that. So that's what I mean when it's the worst kept secret. I wish I could share more information about the specific offering that we're going to have in a couple months. I'm not able to, but the cat's kind of out of the bag. So one of the questions that was asked in the main session was around, clients using HSAs to potentially fund a medical event or a long-term care event. And with HSAs, once you reach a certain threshold, you can actually begin investing those into the actual market, right? So why would you want to do that? Well, you have the tax-free growth inside of the account, and if you're spending it on a qualified medical expense or long-term care, you're able to tap into that tax-free. Well, there's no reason why an insurance carrier can't do the exact same thing with a variable chassis on a hybrid product, right? So you can actually invest funds into it, invest in the sub accounts that are going to be available with it, take advantage of the tax-free growth, which reduces that tax drag, which is another concept that we heard from in that first session today. So you can really kind of turbocharge that account value growth and then have some significant leverage on that growth for a potential long-term care event. So a lot of the reasons why you might want to use an HSA, the biggest downside to an HSA is there's contribution limits every single year, right? So you're not able to put in as much as you want. And when you're talking about how much long-term care can potentially cost, in New York, you're talking $15,000 a month for a nursing home and somewhere around $7,000 to $10,000 a month for a home health aid. You take a look at it and say, well, you could probably pillage through your HSA very, very quickly doing that. You can receive benefits tax-free to pay for that long-term care. But would it make more sense to leave that earmarked for actual medical expenses and then use a variable type of product or a LTC product built on a variable chassis to grow that benefit, protect that benefit, multiply it for a potential long-term care event? And I think you'll see, not just at Lincoln, but every other carrier exploring some additional options to say, hey, if the 10-year treasury stays here at a 100 basis point, these products probably aren't going to be providing the type of leverage that most folks, especially folks in their 40s, 50s, and 60s, where they do have a 20, 30, 40-year time horizon to invest those funds. There might be some additional options for those folks. So that's about all that I can share with it. What I can tell you is the folks at Algren will absolutely be telling you about any product development efforts that we do have at Lincoln. But I didn't want to not address it, especially because I am getting questions on it, and I did see some folks ask about it because the cat's out of the bag as far as the product development efforts that we have underway and some of the info that's already public available. So that's my spiel as it relates to the evolution of LTC. I think you're going to continue to see automations in underwriting. I think you'll continue to see automations and improvements in the process, how carriers are receiving business, how we're putting that business back out there, but especially from a product standpoint, how do we continue to deliver value that folks know and expect from hybrid products like Lincoln's MoneyGuard? How do we get them into a solution that's going to both benefit them and benefit the insurance company, which is a win-win on a tax-efficient basis? So I said a lot. I'm going to pause here. I think we have about 2 minutes left to answer questions before you guys have to move on to your next session. So I'm going to quickly pause and see if we have any questions in the chat. Okay, I don't see any right now. So I want to thank everybody once again for jumping on. Hopefully you took something out of this. It's not often that I get to talk about my background and how it applies to the hybrid space, how it applies to LTC riders on life insurance or traditional long-term care. So thanks again. Any questions, float them up to the folks at Algren, and I'd be happy to jump on the phone and talk further about it. Thank you.